If you've already filed your taxes, you might have done this wrong. Everyone is saying overtime is now tax-free. Sounds amazing, right? Work more, earn more, pay no tax. But here's the problem. It's not tax-free, and most people don't qualify.
Wait, so people are misunderstanding this?
Not just misunderstanding. Some people are already claiming it. Others assume they qualify. But in reality, they may get nothing.
So this isn't just a benefit, it could be a trap?
Exactly. The rule does exist. 2025 to 2028, up to $25,000. But it's not automatic, it's not universal, and it's definitely not tax-free.
So what's really going on?
That's exactly what we're breaking down today. What's real and what's misunderstood. Let's break the biggest misconception first. This is not a $25,000 automatic write-off. Most people think, if I earn $10,000 in overtime, I don't pay tax on it.
Yeah, that's what everyone is saying.
But that's not how it works. This is a conditional deduction tied to qualified overtime compensation.
So not all overtime qualifies?
Correct. Not all income, not all overtime, not automatic.
So how does it actually work?
At a high level, it only applies to the extra portion of time and a half pay.
So not the full amount?
Exactly. Just a portion, and only if conditions are met.
So people are already misunderstanding it?
Yes. It's not fully exempt, it's not fully deductible, and it's not universal. Now let's talk about something critical. What actually counts as overtime? Because if you get this wrong, everything you think you're saving may not apply at all.
Isn't it just any extra money you earn?
That's the biggest misconception. Extra income and overtime pay are not the same in tax.
So how is overtime defined?
Generally, it must meet 3 conditions. You are an employee, W-2. Pay is calculated under structured rules, like time and a half. It is processed through payroll. If one of these is missing, it may not qualify.
What about side income? Gig work, freelance, extra client payments?
In most cases, those do not count. That's increased income, not overtime compensation.
So it's not about working more, it's about how the income is structured?
Exactly. The IRS doesn't look at effort. It looks at classification, calculation, reporting. If those don't align, what you think is overtime may not qualify at all.
So people are getting it wrong from the start?
Yes. And once the definition is wrong, the tax benefit disappears. Now, let's talk about one of the most important distinctions, W-2 versus 1099. Because if you get this wrong, everything you think you're saving may not apply at all.
Wait, some people get nothing?
Yes, a lot of people are asking. Uber drivers, DoorDash workers, freelancers, gig workers.
Yeah, that's a huge group.
Here's the key. That income is usually not considered overtime.
Even if they work extra hours?
Correct. From a tax perspective, self-employed income, 1099, is treated as business income. It is not broken into regular pay, overtime pay.
So overtime doesn't even exist in that structure?
Exactly. And this rule only applies to qualified overtime compensation.
So if you're 1099,
In many cases, you don't qualify at all.
so it's not less benefit, it could be zero?
Exactly. And that's where a lot of people are getting this completely wrong. Now, here's what most people overlook. You can't just claim this deduction, because the IRS doesn't rely on what you think, it relies on what's reported.
So you can't just add it on your return?
Exactly. This only works if everything lines up. The income is correctly classified, it's properly reported, like on a W-2, and the documentation supports it.
So it's not just one condition.
It's alignment. Because the IRS sees how the income was earned, how it was reported, and whether the records match.
What if one part is off?
That's where problems start. One mismatch can weaken the entire position.
So it's not I think I qualify.
It's, can I prove it? And does everything match? Because in tax, numbers are the result, but reporting and documentation are the foundation. Now let's address one of the biggest misunderstandings. This is not tax-free income. When people hear overtime tax break, they immediately think, I don't pay tax on it. That's incorrect.
So if it's not tax-free, what is it?
It's a deduction, which means it does not eliminate tax. It reduces taxable income.
So you still pay tax?
Yes, you pay less, but not zero.
So why do people think it's tax-free?
Because the phrase tax break is often misunderstood. A benefit does not mean no tax.
So the tax is still there, just smaller?
Exactly. And here's another layer people miss. Payroll taxes may still apply.
Social Security and Medicare?
Yes, even if income tax is reduced, these taxes usually still apply.
So you're still paying multiple layers of tax?
Correct. That's why it sounds like tax-free, but the real savings is much smaller. Now let's go one level deeper. Even if you qualify, it doesn't mean you get a large benefit. Because this rule comes with multiple limitations.
What do you mean? If you qualify, shouldn't you get it?
Not exactly. There are at least 3 key limits: a maximum cap, income-based phase-outs, and qualification restrictions.
Let's start with the cap.
Right. Up to $12,500 single, up to $25,000 married filing jointly. But remember, that's a maximum, not what you automatically receive.
So most people won't hit that number?
Correct. Then comes the second layer. As income increases, the benefit decreases.
That's the phase out?
Exactly. Around $150,000 single, $300,000 joint. Above that, the benefit may be reduced or disappear completely.
So it's not for everyone?
Exactly. And the third layer? Not all overtime qualifies, only qualified overtime compensation.
So step by step.
First, only part qualifies, then capped, then reduced by income, and what's left is much smaller than expected. Now, let's talk about a core tax principle: substance over form.
What does that mean?
It means tax law does not rely on labels. It relies on what actually happens.
So it's not about what you call it?
Exactly. Calling something overtime doesn't make it overtime.
So what does the IRS look at?
3 things: how the income was earned, how it flows, how it's reported.
So you can't change it afterward?
No. You can't take regular income and relabel it as overtime just to get the benefit.
That would be risky?
Yes. If form and reality don't match, the IRS will rely on reality.
So it's not what you write, it's what actually happened?
Exactly. Structure flow reporting must all align.
So you can't engineer this?
Correct. If the only purpose is to create a tax benefit without real substance, the position may not hold. Now, let's talk about something more serious: anti-abuse and economic substance principles.
That sounds intense. What does it mean?
In simple terms, you can't design something just to create a tax benefit.
Like what?
For example, trying to structure income so it looks like overtime just to qualify for the deduction.
That sounds possible.
It's risky. If the main purpose is tax savings without real business substance, the position may not hold.
So the IRS looks at intent?
Yes. The IRS generally considers business purpose, economic activity, whether the structure makes sense.
So it's not enough that it looks correct?
Exactly. Even if it appears compliant without real substance, it can be challenged.
So you can't do this just for tax savings?
Correct. Tax results must reflect real economic activity.
So if it's artificial,
The risk increases significantly, and the position may not be defensible. So the most important question now is, what should you actually do? Because at this point, most people start thinking, should I change my income structure? Should I work more overtime? Should I try to use this benefit now?
Yeah, that's exactly what I'm thinking.
Here's the key. Don't start with the benefit.
What do you mean?
The correct approach is, first, understand your income structure. Then, determine if you qualify. Then, evaluate the benefit.
So not how do I get it?
Exactly. Starting with the benefit often leads to forcing the wrong conclusion.
So how should someone evaluate this?
Ask 3 questions. What type of income do I have? Does it meet the definition of overtime? Is my reporting structure clear?
So it starts with understanding yourself?
Exactly. Don't chase the rule. Understand your situation first.
When do you actually consider the benefit?
After confirming the structure is correct and the criteria are met, then you evaluate the amount.
So the order matters?
Yes. Qualification first, benefit second. Now let's talk about the biggest risk here. The real risk is not missing the benefit. It's assuming you qualify when you don't.
That sounds serious.
It is. Because most people right now don't lack information, they misunderstand it.
So the issue isn't not using it, it's using it incorrectly?
Exactly. Once you take a position on a tax return, that position must be supportable.
Meaning you need evidence?
Yes, classification, reporting, calculation must all align.
What if they don't?
That's where risk begins. Adjustments, disallowance, and potential issues.
So the real question isn't how much do I save?
It's, can I support it?
So the biggest danger is being confident but wrong?
Exactly. Misunderstanding plus claiming is the highest risk combination. If you want to truly understand how tax rules actually apply, not just how they sound, then follow Ivy Smart Tax.
So it's not just hearing the rule, it's understanding how it affects you?
Exactly. Because tax rules don't exist in isolation. They depend on your income structure, your reporting, and your real situation.
So the same rule can have different outcomes?
Yes. Some people qualify, some don't. Some get partial benefit, some get nothing.
So the key isn't what you hear.
It's what applies to you, what doesn't, and why.
And that's how you make better decisions?
Exactly. Clarity beats assumptions. Understanding beats trends.
What if someone wants help with their situation?
Follow us, leave a comment, or schedule a consultation. We help you understand whether you qualify, how much you benefit, and what risks to avoid. This content is for general informational purposes only and does not constitute tax advice. Based on current IRS guidance for tax years 2025-2028, application depends on individual facts and circumstances. Future legislation or IRS guidance may change the outcome. Consult a qualified tax professional before making any tax decisions.